Hi, I'm Linda Eedes, and I'm here with Portfolio Manager Wim Murray, and he's one of the portfolio managers for the Foord Equity Fund. And we're going to be talking about SA stocks in particular and some of the themes impacting our thinking. So Wim, let's start with some good news for this last quarter. We saw Naspers and Prosus, both of which are positions in our fund, up significantly. More than 40% for Naspers, more than 30% for Prosus. What happened there? And given that we've seen such a rally in the share price, will we still be holding these stocks at the same levels?
Very positive development for us. So essentially what they announced was they'll do a sell down of the Tencent stake, and then they'll buy back the Naspers shares. So, the mathematics of doing that is incredibly attractive, and they've done it on an open-ended basis. So they will continue to do it as long as there's a significant discount in Naspers or Prosus to the underlying assets they hold. So even if we don't see a closure of the discount, it actually on a per share basis adds a lot of value to us as shareholders. Now the question becomes, from this level going forward, how do we see it? But if we were to take the year-to-date performance of both shares, we actually see Naspers slightly up for the year and Prosus still down slightly. So the strong reaction we saw in June was mostly a recovery of some previous losses. And we believe on a fundamental basis, there's still a lot to come. Firstly, the commitment to actually buy back the shares is an important development. One of the big questions shareholders and the market have had around both Naspers and Prosus was capital allocation. So the question becomes, one day, if you do sell your Tencent, what will actually happen with the cash that comes in? And by committing to buy back the shares, one can now, with a greater level of certainty, go and do the calculation and actually see how that plays out for shareholders. And a very important point to note, for long-term shareholders, on a per share basis, your exposure to Tencent actually increases. And as long-term shareholders, we think that will play out to an even greater degree because of the buybacks that will happen over the next while. So we think it's incredibly attractive. We think the fundamentals of both Naspers and Tencent continue to be very attractive. And it's one of the largest positions in our fund, and it will continue to be.
Okay, great. Now the other position that has created some underperformance for a while, but that turned around this quarter, is the fact that we tend to have lower resources stocks than the index, than the market. And we know obviously South Africa does tend to have more resource stocks in the index than the global index, for instance. That actually contributed to our returns from a relative perspective, the fact that we have a lower resource allocation. Where do we think sort of the commodity cycle is going? Are we still going to retain that underweight, or given the fact that that sector has pulled back, would we be increasing our exposure to resources?
So structurally, we remain underweight in resources. And South Africa is a very interesting example where you have a very big weighting towards a certain asset class, which to a large extent is just a function of a small country having found minerals in the ground in South Africa. But if you were to take a step back and ask what is a conservative approach towards capital allocation, it's very difficult to get conviction to have that much within your portfolio. So we remain structurally underweight given the large weighting in the index, and also the cyclicality within the earnings of resource companies can be very pronounced based on the underlying price of the commodities, which does make us cautious. But taking a step back, we still do have certain counters that we think are interesting. Anglo American and BHP Billiton have been staple holdings for us for quite some time, and they give us exposure to iron ore and also to copper. And copper particularly, we like the long-term fundamentals of the commodity. So we think as there's greater electrification within the world and the move towards a green economy, the copper price should continue to benefit and demand should continue to remain strong. So for Anglos, we think there's decent volume growth to come. There's some cost-cutting initiatives that they can help to assist earnings going forward. And for BHP Billiton, they have best-in-class margins, very attractive return profile, and that's a function of them operating at the lower end of the cost curve, which we find very attractive. So the free cash flow coming out of these businesses are very attractive. And at the moment, they offer high single-digit dividend yields, which we also think is an interesting proposition for investors. But taking a step back, you need to position yourself in the context of the macro environment. So we're seeing rising interest rates, we're seeing QT being implemented, and there's some uncertainty around global growth going forward, and also uncertainty around the growth within China, which we've seen slow down slightly in recent years. So marrying all that together, commodities to a large extent, the pricing is a function of supply demand within the economic cycle, and it's an interesting place at the moment where we see the next the medium term playing out. So we are conservatively positioned. We think in absolute terms it's a decent weighting towards the sector, but we would not like to be overweight, and we're still cautiously assessing the scenario play out based on the list of probabilities we think could incur. So we're happy with our positioning there, despite the pullback and despite still being underweight.
So looking at SA, Wim, we all know the challenges that we face as an economy. We're obviously all sitting through, at this stage in time, significant load shedding. There are a lot of issues or headwinds that are facing local businesses. But you're managing a South African equity mandate. You're having to invest in equities within the local environment. Now, we do have some businesses that are more global in nature, but could you perhaps talk to some of the more local companies that we think will be more robust through these difficult times?
So actually, at the moment, we're seeing several interesting opportunities, and it's a wonderful time to be an active fund manager. So you always try to marry the price and the valuation of the stock compared to the prospects for the business and both the macro environment and all the rest. So we try to find instances where we think the market is actually missing something, or where we think the company can continue to gain market share despite the difficult environment. And therefore, the prospects are slightly better than peers, and also on an absolute basis, they are fairly attractive. So one of the recent opportunities we have come across is RMI. So they've announced the unbundling of both Momentum and Discovery. And the result of this is that RMI becomes a fairly clean proxy for the OUTsurance business, which is one we've been following for some time. We really like the core SA business, which is incredibly attractive. And then we also like the management, which we think is first grade. What we believe the market is slightly missing at the moment is, if you were to just optically look at the return on equity for the business over the past number of years, it's been dwindling down. But that, to a large extent, is simply a function of them owning Hastings, which is just a simple equity holding. And then also they have new initiatives where they've gone into life insurance for SA. And that is still in the loss-making stages of development. So as we go forward, they've sold the Hastings business. So we'll see the group return on equity actually track closer to the operations of the group, which is core SA and some of the Australian businesses. And then we'll also see the new initiatives go from loss-making to actually starting to contribute to profitability. So we believe there's an attractive jump within the return metrics of the business to happen over the next few years, and it will actually improve over time as the new initiatives start to contribute. So all in, you have a core SA business doing returns on equity of 50%, and then the group overall sitting at 22% at the moment. So we'll think it will go towards the low 30s and trend upwards towards the high 30s over time. And we could well see earnings double over the next 5 years, while in the meantime, we're getting a 6% dividend yield on the stock. So something like that's very attractive. We like the quality of it. It does play into how we think about businesses and where we actually want to invest. And you can sort of just sit back and let the business do its thing over the next 5 years.
So it sounds like we've got a good blend of businesses that are more locally oriented but robust for various different reasons, as well as businesses which are more global in nature. And ultimately, I suppose it is about the fundamentals of the businesses and the price that you pay for those future cash flows. Thanks, Wim. In terms of contextualizing any specific stock that we speak to, just a reminder that we do manage a diversified portfolio of many different investment ideas, and that overall portfolio construction does help to protect against the risk of any one specific company. So just to bear that in mind. Thank you for joining us. Thank you, Wim, and we look forward to continuing the conversation in the next quarter.